Welcome back to the Discount Property Investor Podcast. Our mission is to share what we have learned from our experience and the experience of others to help you make more money investing like a pro. We want to teach you how to create wealth by investing in real estate the Discount Property Investor way. To jumpstart your real estate investing career, visit freewholesalecourse.com, the most complete free course on wholesaling real estate ever. Thanks for tuning in.
All right, guys, welcome back. Today, Mike and I are going to be talking about the advantages of owning real estate.
Man, right now there are a lot of advantages.
There are, especially with the government printing $2 trillion in stimulus.
You read my mind, Dave.
Damn. I mean, there's really no better hedge against inflation than the scarcity of real estate. I mean, I say that because it's very scarce. We're not making any more of it. Some people will argue, oh, they're doing that over in Dubai. Well, that's fine, but the cost to create it is way more than to buy existing.
And
so that's
actually creating.
That is a bullshit excuse. Land is land, guys. They're not making any more of it. Yeah, you want to dump a bunch of dirt into the ocean
and raise
it up. That's fine,
there.
but you're going to spend $1 billion doing that. So good luck to you and that dumbass argument. So moving on, they're not making any more land.
How do you really feel about it?
That's how I really feel about it. It's the stupidest thing I've ever heard.
Well, they are cool though. Those islands that they build make like little palm tree shapes.
Yeah,
they're freaking
They're
cool.
really neat, man. But that's not happening in Missouri.
Yeah.
Right? Where we're investing?
Anywhere in the U.S.? I don't think so.
No.
Yeah, I'm not seeing it. So, advantages of real estate. I love that you brought up the government.
How do you really feel?
I love that you brought up the government printing money because that is a huge thing on my mind, and I know a lot of other people's minds right now.
I just bought some Bitcoin mining machines this morning, man.
Yeah, we're going full crazy, man.
Yeah.
We're buying gold, we're buying silver.
That's right.
Stocking up on ammo,
That's right.
Yeah.
And of course, always real estate,
And
guys.
of course, real estate.
Never stop that.
And that's just it. So real estate is comprised of a bunch of different materials, right? You've got the lumber, you've got the concrete, you've got the land itself, you've got the roof asphalt shingles, you've got the copper wiring, the pipes, all this stuff. So all of those things, as the value, let's not talk about value. Let's talk about the price of those goes up. What happens to a piece of property? Well, the cost to build that piece of property goes up as well.
Man, lumber. Speaking of cost, man, lumber is way up right now, like almost 200% plus. Maybe even 300%.
Let's talk about that, man. So it used to be about $10 to put a 4x8 sheet of plywood. It would be about what you pay, about $10 for a 4x8 sheet of plywood to be delivered to your roof via some of our contractors. I think they charged me like $25 last time.
Hey, look at this. I'm actually pulling up a NASDAQ market activity commodities report for lumber. And this is a 1-year chart, so you guys aren't going to be able to see this. But
pull up 5.
Oh, you want to do a 5-year chart? Okay, but we'll explain what we're looking at here. So basically, 5 years ago, this is probably, is this a futures thing? I think this might be futures when it comes to commodities. But either way.
100%?
Well, it's... there's a number here. So basically, if we were to go back 5 years, you're looking at 236. I would assume that's per contract, right? $236 per contract.
No idea what you're looking at.
And just recently, we hit an all-time high. It looks like of 818. So 2468. That's a 400% increase over 5 years. That's my point.
Yeah. So if you don't believe that inflation is happening or is real because the CPI or Consumer Price Index doesn't reflect it, it's because the basket of goods in that Consumer Price Index is artificially kept lower.
That's right.
Because the government decides, not the government necessarily, but whoever is determining what is in that basket of goods gets to kind of manipulate the numbers. The government also incentivizes and decreases the price through different taxes, tariffs, and other programs. They can keep the price of certain goods lower, and they can have the price of other goods go up through tariffs and things like that. So there's a lot of manipulation in those things, but the cost of air conditionings, Dave, it is gone through the roof.
The air
conditioners. We've replaced so many ACs.
Yeah, no, we do. I don't keep
God,
track of the.
It's like $4,000. I can't even get it.
What was it? What was it like 2 years ago? Like
2,500,
27,
maybe?
28.
Like you could get a cheap one.
So that's up 25%
and
too.
again, I know that again people take advantage. So hey, prices are up. I'm going to add a little more to my labor cost, but they should.
Yeah.
If they're. Long story short, going off on a tangent, there's definitely a lot happening in finance right now.
Yeah.
In the stimulus packages, and like Dave said, $2 trillion worth of money being printed. They've created it. So, Dave, you were mentioning to me you were reading a book called.
It's a brand new one. No, not brand new, but it's Robert Kiyosaki's book, and it's called Fake. I just started reading it yesterday. And it's so I don't really know a whole lot about it because I'm not that far into it. I'm maybe 10% into the book at this point. But the summary of it is a personal finance book. It's basically trying to simplify a complex and often confusing subject of money as well as investing. And Robert Kiyosaki he challenges conventional wisdom. And he asked the questions that will, help readers sift through the information overload, to understand how money works. And he calls the title of the book is actually Fake, and the subtitle is Fake Money, Fake Teachers, Fake Assets. So again, I don't want to get off on too much of a tangent here, but it aligns very well with what we're talking about here.
Right. So it talks about how the dollar is a fiat currency. So we went off the gold standard a while ago, and now...
And this is relatively new, guys, April of 19.
And so just talking about
less than a year ago.
Robert Kiyosaki's book, Fake.
Wait, what year? We're
originally
in 21,
published.
aren't we?
Yeah, it's a year.
About a year, give or take. Yeah, that's great.
So again, that's Robert's book, Fake. It's pretty interesting on the topic as well. So we were talking about the advantages of real estate, and we went down this tangent on the fact that inflation is happening or the value of dollars decline. And this is something that happens. We can kind of tame it down a little bit. We know this happens. It happens slowly, and sometimes it happens more rapidly. So it's an ongoing thing that you're going to deal with. And real estate has been a proven asset class that hedges you against inflation.
Is that referred to as elastic or not?
Dude,
isn't that what they call that?
Economics.
Yeah. I don't
know.
think it's elastic. I mean, meaning that you can't really make more of it, right? So either way.
Again, man, I got a minor in economics, and my brain I don't remember.
That's right.
I don't remember the... Yeah.
That's right. Well, either way, inflation is a big deal, guys, and it is happening more now, or I should say this. We are about to see more inflation than we ever have, at least in my lifetime, and I'm mid-30s, because we've never in my lifetime printed this much money. And it's one thing I do want to make a note of is whenever I say printing money, that doesn't mean it's actually coming off of like a printing press. It really just means that it's being created. Right? So like if the government, creates a $1.9 trillion stimulus package, they may print a few $1 billion to actually, get it out into the masses, but the majority of it is just created in a computer. I think it's 98% of all the money is just in a digital ledger, right? So either way, we're making more money. That's where the inflation comes in. So let's talk about some of the other advantages of owning real estate.
I can't. I love this one.
You're stuck on this inflation,
I'm stuck on inflation, man. I'm stuck on inflation. No. So another one, and this is huge, and we're not experts on it, so we get CPAs to help us. But that would be, you're going a different direction. I was going to say the tax advantages, man.
Yeah, absolutely. So there's a couple ways that works.
Depreciation right there.
Yeah, a couple ways that works. So you get depreciation, which is basically the way I like to look at it is it's a phantom. It's a phantom expense, meaning it's something that you're able to basically offset your income with. That's what you typically do with expenses whenever it's tax times. But depreciation allows you to have an expense that you didn't actually have to incur. And the way that it works with single families is you get 27 and a half years to depreciate a property. So basically, take the total value of a property. Let's say a property is worth $100,000, and you divide that by 27.5. That means that every year you're going to get about $3,600 and change of phantom expenses. Now, the downside to the depreciation is it does affect your cost basis. Now, I don't want to get too deep into accounting, but basically, profits are determined when you sell a property and taxes are owed. All right, they're also going to be owed on the cash flow every year. But when you go to sell that property down the road, you are going to have to pay taxes on any gain. Okay, if you bought a $100,000 house for $100,000 and you paid full retail for it, your cost basis is going to basically be $100, right? That's what you paid for it. But every year, whenever you add this phantom appreciation, right? Or I should say this phantom expense, which is depreciation. I really screwed that up, didn't I? When you add that in, it's going to reduce your cost basis by the amount of that expense, right? So after a couple years, your cost basis is no longer 100. It may be, 94 or 95,000, right? After a couple years. Well, after, let's say 10 years, you may have a cost basis of 70,000. And if you go sell that property for 100, even though you are selling it for the exact price you bought it, taxes are due because that depreciation catches up to you. And that's what we like to call cost basis, and the depreciation directly affects the cost basis. Now, rich people write the laws, guys, and the rich people have made a loophole for this. And they basically said, well, if you sell a property, there should be this way to exchange that property for another property or a like-kind asset, and that's referred to as a 1031 exchange. And a 1031 exchange will allow you to kick that can of dealing with the cost basis down the road. So another advantage, Mike, that we can add in here is 1031 exchanges. Mm-hmm. And the 1031 exchange, it really affects, the main reason that a 1031 is valuable is A, it's to prevent paying taxes, but B, it allows you to use compound interest essentially in the real estate game. Because you're being able to control assets that are larger than your current supply of money, right? Because you're not having to pay taxes on it when you exchange. So definitely a cool little thing. And again, I don't want to get too deep into the weeds on that, right? So depreciation is real, and you can actually
and it's awesome. It's awesome while you're doing your taxes year in and year out. I just sold a property, and it is great because it's like, oh yeah, this is cool. I'm not paying as much taxes because I'm got these expenses. Man, when you go to sell it, if you don't do a 1031 exchange, it sucks.
Yeah, so I just sold one of mine.
It sucks.
One of the first houses I bought, I think it was the second house I ever bought. Mm-hmm. And basic math, guys, I think I paid about $130,000 for it. I owned it for like 13 or 14 years, and I sold it for about $180,000. So there's about a $50,000 difference from what I bought it and what I sold it for. However, the property got paid down by the tenants that were living there, and I depreciated it. All right. So what ended up happening is you would think like, in a simple world, like you buy for $150 or $130, you sell for $180. That's a $50,000 amount of money that you made. Well, and the way that this really worked out, I owned it for 13, 14 years. I actually got a deposit of closer to $90,000 when I sold the property. And because I had paid that property down a ton, however, all $90,000 of that.
That's not even the number that matters.
That's not even the number that matters. The number that matters is the difference of the cost basis, which was decreased from 130 to, let's say, 100. And then I sold that property for 180. So now I owe taxes on 80,000, not 50. And you would think, again, you bought it for 130, you sold for 180, that's 50. But every year I depreciated that property, reducing the cost basis. So I actually had to pay taxes on about 80 of it. So that's fun.
That's the nuts and bolts of depreciation. That's why a lot of people do 1031 exchanges. You have to be exchanging it though, and man, they got complicated.
Well, just use a lawyer or a title company,
and that's exactly
they facilitate the whole thing.
That's what our accountant just told us. She said, "I used to do."
They're actually really easy if you let them do it.
Oh yeah,
yeah.
Well, that's what she said. She said it's a really complicated. They got complicated, so I'm out.
Yeah.
I refer
Go to
to
your
this
title
person.
company and say, here's what I'm selling. Here's what I'd like to buy. Give them all the information. They're going to handle it for you. That's typically what they do. It's how they get paid,
So
right?
that's depreciation 1031.
That's depreciation. So there's a flip side of that, though. Appreciation.
And let's use your example, Dave, that you just said.
Okay.
So Dave bought this house for $150,000.
130.
Or I'm sorry, $130,000. But he was able to sell it for $180,000.
13 years later.
What happened?
He sold it for $180,000. It was $50,000 higher. So
That's appreciation.
it has a little bit to do with inflation too, though, right? Like the amount of dollars that the amount of goods that a dollar can buy decreases. So you need more dollars to buy the same amount of goods over time. And I think we're going to be really getting into a time frame here, Mike. And it may not be this year or next, but I don't see how it's humanly possible that within the next 5 years that we don't go into a double-digit inflationary period.
Yeah, it's 3 to 5 years.
I just don't know how how the government can prevent that. I mean, maybe not high double digits, but like I just don't see how it could stay in the single digits. I
think
really
that's
don't.
best case.
I think that's best case. Yeah,
No, I think we will see some significant inflation, and I'd say 3 to 5 years.
Yeah, it's going to definitely be delayed, but not 10 years.
Yeah, I mean
It's going to be closer to 3 to 5 for sure.
everything in economics takes a couple years to manifest itself, and that's why each party gets to blame the other one for whoever was in power 3 years ago, and they say, "But this guy's doing this," and it's
so
just a mess.
The definition of appreciation is really just the value of an asset, or really just the value of anything, going up
The increase
with
in value.
time. Yeah, it's an increase in value with time. Now, depreciation isn't the flip side. That's where it's confusing. It doesn't mean that the property is actually decreasing in value. It's a phantom expense. So depreciation is more of a tax language term, whereas appreciation is referred more to the value of an actual good.
Yeah, well, but it is the flip side though, Dave. So appreciation, you're talking about $150,000 or $130,000 house becomes worth $135 the next year. In the appreciation model.
Yeah,
In
according to the
depreciation-
tax,
in the
yes, it does.
depreciation model,
Yes,
your 150 becomes 145.
right.
So you're depreciating your
Cost
cost
basis.
and your actual value is appreciating. So again, it's it's complicated. They are reverses. They're not exactly the same.
Yeah, they're just on different playing fields. One's on a tax playing field. The other is on an appraisal valuation playing
And
field.
it's all made up.
Kind of, sort of.
It's all made up.
Sorry.
Just like whose line is it anyways? And the numbers don't matter.
Right.
So,
All right, cool. So, guys, inflation. We talked a lot about that. This episode is all about the advantages of owning real estate. So, inflation, I think, is really a big deal because it is a hedge. So, an advantage of owning real estate is a hedge, right, against inflation. Right. We talked about that. We talked about depreciation and how it's an phantom expense and how you can avoid it with 1031s. We talked a little bit about appreciation, which basically just means that over time it's going to cost more money to buy it, right? The value of that asset is going to increase. Now, before we move on to, let's say, cash flow and a couple other advantages, right? Let's talk a little bit more about appreciation. Not everything appreciates. In fact, most things in life depreciate. Mm-hmm. Cars are not assets; they are liabilities, unless there is those people out there that are going to have that argument of, well, what if I buy, an old car that has value
or, a
or
sports
something
car
like that,
a Ferrari or a Lamborghini.
Don't disagree, right? Don't disagree. But typically, this is a fun fact. There's 900 million cars on the road today. So I'd be willing to say that 899 million of those cars are depreciating. You may have a million out there that are collector's items, right? But the rest of these are depreciating, right? Clothes, depreciating assets.
Wives. Depreciating. Wait a minute.
But most things that you buy are going to be worth less. Like think about it. If you were to buy something and you have the option of buying a brand new item versus a used item and they're the same cost, you'd always pick the new item, right? Whenever something's lightly used or it shows worn or it, whatever, it's going to be worth less. Well,
everything. This microphone that we paid $300 for.
Yeah, you could sell that right now for probably about $100, right?
Best case.
Best case. But the thing about real estate is it doesn't always depreciate. It doesn't always depreciate either. But as inflation kicks in, it forces the appreciation. So again, it is the best hedge against inflation that I am aware of. Some people might argue that it's gold or that it's silver, but the thing is about gold and silver is you can mine more of it. Real estate, unless you're in Dubai, you can't really make more of it. So
yeah, and I mean, there's you can build more houses and yada yada, but it's all the assets that comprise that piece of property. They're all going up in price. So yeah, it's going to cost more to even build more of them.
Love it.
So yeah, it's interesting.
There it is,
Let's
folks.
Talk about cash flow,
there it is.
Man.
Cash flow. This is probably the most fun.
This is the simplest one, and I think the main reason why people are like, oh, I want to own rental properties. I want some cash flow, right? I want to generate income. Like that's the easiest one to understand. That's what. I mean, I think that's what gets people excited about real estate when they first get into it.
So, Mike, I think the easiest way to define cash flow is what is left over after all the expenses are paid. And when I say all, I mean all. Because sometimes you may not have a monthly bill for insurance or taxes, right? So cash flow is really, I think the easiest way to calculate it is on an annual basis. You also have to factor in vacancies into your property. So without getting too much in the weeds, guys, cash flow, all right? You make cash flow on properties that are income producing, period. If a property doesn't have any income, there is no cash flow. It doesn't work that way. You have to have properties bringing in dollars and cents in the form of rent payments or leases, or it could be something, outside of that even, like easements or whatever else, agreements, but it essentially has to be bringing in income. And if it is bringing in income, if the income is higher than all the expenses, what's left over is called cash flow. So you could rent a building out to, just like let's say it's a single family home. Well, you could rent it out and you'd have tenants live in there and they're going to pay you rent. You could also rent out raw land to a farmer, right? And he's going to pay you to be able to farm his crops there. You could also have a commercial building or a strip mall or even a big office building. And again, you are renting, you're trading the time in that space for money. And that's rent. So that's bringing in income. Well, all of these things, commercial buildings, land, single-family homes, are going to have expenses. Some are going to have more than others, but you're going to have taxes that are going to be due on the land. You're going to have taxes that's going to be due on the improvements to the land. You are going to have insurance, especially if you have a loan. If you have it free and clear and paid off, then you may not need it or want it. But if you have a building on it and there's debt due, any lender is going to require you to have insurance.
I'll probably get insurance either way.
Either way, I don't disagree. I'm just speaking in black and white here. Next, you're going to have utilities. Now, again, if it's a farmland, you're not going to have that per se, but you still may have to have additional insurance for your crops, right? But if you have a building that's a residential house or a commercial, building or a strip mall, something like that, you're going to have utilities. You are going to have maintenance. And then you are going to have a vacancy, which basically is an opportunity cost. A vacancy just means that it's empty and that it is not bringing in money. So again, you want to factor all these things in. So, cash flow can be looked at daily, weekly, monthly, annually. I like to look at cash flow in terms of annual expenses. And the reason is because you may not be paying your insurance company or your taxes weekly or monthly. They typically come out at the end of the year, right? So cash flow can be skewed if you're not calculating in every expense. So it's very important that you understand that cash flow is what's left over after all expenses are paid.
Well said, man. Well said. And I tend to agree. I think it's easier to calculate it over a year period. And that's how we like to figure it. But then I like to look at it.
Oh, yeah. I want to see, am I making $50 a month or am I making $650 a month? Yeah. Absolutely.
To me, that's just... Yeah,
but the problem with that, though, is if you need a new HVAC, like Mike mentioned earlier, and it's $4,000, well, that's going to eat up, assuming you have a property that cash flows $400 a month, 10 months of cash flow. So, yes, you definitely want to know your monthly numbers, but at the end of the year is really going to be kind of, the truth. What was the actual cash flow? Because it's one of these things where you can never know in real time.
Yeah, well,
it's always something that's going to be trailing. What was the last year's cash flow? Right. And that's a fixed number. You can't change it once time's passed. Right.
That's a great point. And I think that example, the air conditioner, that's something that happens. I mean, we replaced a ton of air conditioners.
Roofs,
so your
trees falling down,
your cash flow,
all types of stuff
on the monthly, even on a per property basis, is pretty hard to determine on a single family house.
Yeah, but you can estimate it really, really easily.
So what we do is, we'll use a 10% vacancy. So basically, take your entire cash flow, then take 10% off for vacancy. Because, again, that's maybe 1 month vacant, right?
Yeah, it's only 1 month. That's right.
Take 10% for your capital expenditures. Does that be something like an HVAC?
Roofs, trees falling down, sewer lines getting clogged.
Yeah, so those are other
big ticket items, basically.
Then general maintenance, another 5 to 10%.
Yeah, I'd say maybe,
Just give it 10%.
Call it 10%, right.
So there's about 30% right off the bat for things that most people aren't really factoring in. When they look at their rental income versus their mortgage payment.
Great point, Mike. Great point.
So again, if you have a rental payment of $1,000 and a mortgage payment of $700, your cash flow is not $300.
No, not at all.
Now, if your $700 factors in your insurance and taxes, that's great.
And CapEx and vacancy and maintenance, but it doesn't though.
Yeah,
right.
So that's why a lot of people end up being very, very cash poor despite having a bunch of assets, because they're not actually cash flowing over a period of time. It looks like it. They think, I should be making $300 a month on these 6 properties I own, when in reality, every month there's an AC or a roof that needs replacing or a vacant property that they have to pay the mortgage on, and they're not collecting rent, and all yada, yada, yada. So it's very, very important that you do not, Dave, you're typing the words I'm trying to say.
That's right.
That you do not leverage yourself, meaning you don't want to take out a loan that's too high, driving your cash flow down. You have to make sure that you still cash flow on your properties. That's the only reason to buy a rental property, is to create cash flow. That is not the only reason. That is the number one reason to buy it. Again, that to me, everything else is icing on the cake. The cash flow is number one. The depreciation is icing. The appreciation is icing. The tax advantages are icing on the cake. To me, cash flow is the only thing that, it really, really, really matters. You have to think about that. I don't know. I can't say it any differently.
No, absolutely. So, guys, a couple more advantages of owning real estate is that your cash flow is taxed as passive income. So if you don't understand what this is, let me just try to explain this to you very, very, very simply, right? So according to the IRS, there are a few types of income, okay? And these types of income tax, let's actually pull this up here. It looks like there's 3 basic types of income, okay? And the differences are how you earn it. So the first type of income is taxes on what you earn, right? This is basically what you're doing when you trade time for money, okay? The next type of taxes are going to be taxes that are going to be based upon how you earn it. So if you are earning money from your money making you money or your real estate making you money, that's actually defined as passive income. And then the other type of income, and there's probably a couple more here, but the other type of income would be income that is earned from capital gains and or dividends for the most part. But the cool part about real estate is that income is defined as passive income. And again, laws are written by rich people to protect rich people. Guys, if you have not heard me say that before, I'm going to be really surprised because I preach this all the time. People that work at Taco Bell or McDonald's don't typically end up in the Senate or the House of Representatives, on committees voting on bills. What ends up happening is rich people decide that they want to up their game and they run for public office and they have to spend a lot of money to get all those votes. So it's very rare that somebody that is in office, doesn't come from some sort of means, or they're just very, very resourceful. So rich people, they tend to make a lot of their money not working for it. They let their relationships make them money. They let their assets make them money. And more importantly, they let their money make them money. Well, rich people aren't gonna shoot themselves in the foot. So what are they gonna do? They're gonna make laws that say, well, if you work for your money, you should pay the most amount of taxes on it. And if you're like me, the rich guy, and you make, 70, 80, 90% of your money from your money making you money, then we should be taxed less. I don't necessarily agree with the way that this is designed and the way that it's carried out, but I acknowledge it, and I'm going to play the game the way the game's going to be played.
Don't hate the player.
Don't hate the player, right? Hate the game. That's
right.
A great point, Mike. Right. So with that being said, there is a massive advantage of making money or cash flow from real estate because you are actually taxed in a whole different bucket than all of your earned income, right? So it's funny because every day when I wake up, and I think Mike has the same mindset, but our goal isn't really to make more money because that means that we are going to have to pay more taxes. Instead, we've changed our entire mindset to say, how do we control more assets? It's a whole different ballgame than saying, how do you make more money? Because here's the cool thing about controlling assets. You build wealth. And wealth isn't taxed, my friends. Income is. Whoa, wait. Say that again. Wealth isn't taxed, my friends. Income is.
Yeah, it's crazy.
So if you
really
could spend all year working on building 3, 4, 5, maybe even, $500,000, maybe even $1 million worth of wealth, and you didn't sell anything, you wouldn't actually have any taxes due. But if you spent your whole year trying to increase your salary from $50,000 to $200,000, $300,000, $400,000, you are going to 5, 6, 7x the amount of taxes you're going to pay too. So really the goal isn't to make more money, it's to control more assets, therefore creating more wealth, because wealth isn't taxed. So passive income is a tax classification, and you get that via real estate investing, right? And there's really one more thing that I'd want to touch on with the advantages of owning real estate. And here's the thing, guys, there's probably 100 advantages. These are just the top, 5, 6, 7 that Mike and I like. And the last is leverage. It's that simple, right? You can go open up a stock account with $1,000, and the brokerage is going to say, hey, we're going to give you money on margin. And they're going to essentially let you borrow anywhere from, $1,000 deposited. They're essentially going to say you can go buy stock worth $1,500, maybe even as much as $1,800. So they're actually going to give you money to play with, and they're going to charge an interest rate on that, right? But they're not going to give you a 500% increase. Well, with real estate, they will. You can go buy a $100,000 piece of property with only $20,000 and get a loan for $80,000. That's 5 times your money, basically, on the loan. We talked a little bit earlier in the last episode about using VA loans or even FHA loans, and that increases the leverage even more. Think about if you only have to put down 3 to 5% to buy an asset, and you can get a loan for the difference. Whereas if you want to go buy gold bullion, good luck. You're going to have 100 cents on the dollar, most likely, to buy it. Same with the stocks, right? And most people that I know that invest in stocks, they don't even use margin. So if they only have $1,000 in their account to invest, that means they only have $1,000 worth of assets to buy. Well, with real estate, it is so incredibly easy to use leverage. In fact, banks encourage you to use leverage. They say, hey, you want to go buy this $250,000 building? That's $250,000. Well, assuming that it's a standard loan, you only have to bring 20% to the table, which means if you have $50,000 saved up, you can go control an asset worth $250,000. So that alone is probably, mixed with the cash flow, of course, is probably my favorite reason that I like real estate. And really, there's so many of these reasons. But if you are able to control assets by using other people's money, and I'm sure you've heard that term before, OPM, then not only is it going to help you increase your wealth at a much faster rate, but it's also going to allow you to buy and control assets that are kind of out of your price range, essentially, in terms of cash buying.
What's really neat about it, though, is that they all work together to help you build wealth.
They do. And that's the beautiful thing.
So cool. So again, David mentioned you're going to use $50,000 of your own money to buy that $250,000 building. Well, guess what? You're going to use that $50,000. The bank's going to give you the $200,000. The tenant in that building is going to pay the mortgage for you. So then you're done, and you're going to cash flow positive.
That's right.
What's even more powerful,
right.
we talked about in the last episode, is the BRRRR method.
Love this.
So you buy another one another year later. You buy another one a couple years later.
Or even a couple months later.
Then refinance the other ones. You could pull all your money out. So that $50,000 you had to put into it, if that thing appreciated, now it's worth $300,000. Then you get a 75% loan to value or 80% loan to value. You're going to pull out all your money.
Yeah, so you can actually use leverage if you get good at it and you understand it, and you can actually use leverage to not even have any of your own money in the deal, right? Now, you don't particularly own it when you have a mortgage. You control it, right? But that's really what matters, though. Do you need to own something? Not necessarily these days. It's all about having the control. So, guys, lots of advantages of owning real estate. Inflation, depreciation, appreciation, cash flow, leverage. And, of course, all of these things help when it comes to tax advantages, with real estate being passive income as well, guys. So tons of ways to have or tons of advantages of owning real estate. Guys, go ahead, please.
I was just going to say, check out the discountpropertyinvestor.com website. We relaunched our website. There's tons of information on there. We've got free courses in there, free books we give away.
All of our podcasts are hosted there, too.
All of our podcasts hosted there. Thank you so much for listening. Thank you for your support. Again, we'll talk to you guys next time.
Signing off. Thanks for listening to the Discount Property Investor Podcast. If you enjoyed this episode, please like, share, and subscribe to help us reach a wider audience. To jumpstart your real estate investing career, visit freewholesalecourse.com, the most complete free course on wholesaling real estate ever. We would also appreciate it if you left us a review on iTunes or Stitcher. Thank you in advance for your support. And remember, you make your money when you buy, you get paid when you sell. Now let's go build some wealth.